If you're looking at the headlines this weekend, it is looking ugly. We have hot inflation, stagflation whispers, and now the US-Iran situation is escalating rapidly, just as we are speaking right now. But at the same time, when you look at some companies' earnings, we have companies like Dell, they are reporting monster quarter. And so we are seeing a market that has completely two different realities. So in today's video, I am going to break down the macro risks that you need to worry about. We're going to review the earnings winners and losers from last week. And most importantly, I am also going to share my personal game plan for next week. Because if you are not prepared, get ready for a while, right? Now, let's start off by looking at the inflation data that came out last Friday, which was the core PPI data. So the core PPI actually came in pretty hot. So core PPI actually excludes volatile food and energy prices, and it actually rose 0.8% in January, much more than expected. So for context, back in December, it actually gained 0.6%. So if you analyze that, it's very clear that inflation is running above the Federal Reserve target. Okay, and you can see that this actually flowed down to the sell-off we saw on Friday. In fact, this was a single data point, which was the primary catalyst. So what I think actually happened is that people felt like, oh, inflation is getting hotter than expected. It means that the Federal Reserve will not be able to put rate cuts on the table, right? As we know that earnings of most companies have already been reported. So what are people looking forward to? They are looking to the macro, whether the Federal Reserve will they spur the economy more by cutting more rates, or will they tighten the economy by increasing rates? So this hot PPI tells the market that the Federal Reserve will still delay their rate cuts, maybe even further. And that is why we saw that rate day last Friday across the indexes. And normally, these data will tank the market, which is what we saw. So this is expected, but it should also send bond yields skyrocketing. But what actually happened to bonds, okay, which is the 10-year treasury bond? Yield actually fell, right? The 10-year yield actually fall below 4%. And why? It is because of this important word over here, stagflation risk. Okay, so what is stagflation? Okay, what is stagflation? But before that, right, before we talk about stagflation, there are also another reason why we saw the 10-year yield falling below 4%. And in fact, when the market opens on Monday, we are probably going to see a little bit more impact. And it is because of this first massive risk, which is the escalating US-Iran tensions. Now, what we know happened literally on Saturday, right? Which is that the US has officially attacked Iran. But before that, over the past few weeks, there has already been escalating US and Iran tensions, which has been affecting the bond market. But with this fresh news that US and Israel has officially attacked Iran, okay, Trump has also sent a message, and Iran has retaliated by attacking back US bases in UAE, in Qatar, and Dubai, and all flights have been suspended. So this is also scaring the market. In fact, right now we are already seeing some reactions in crypto market, and on Monday when the market opens, we are going to see that short-term fear appearing in the bonds market. We are going to see that appearing in stocks as well, right? Because with the escalating tensions and now with war being even more real now, the possibility has increased. What investors will do is they will rush to US Treasury for safety. And when investors rush to US Treasuries for safety, that means the bond prices will go up. And when bond prices goes up, it will cause the yield to drop further. So this is one of the massive risks that the market is pricing in, and we should see that being affected more on Monday. And the second risk is stagflation. Okay, so what is stagflation? Stagflation is basically the worst case scenario for an economy. The last time that we saw stagflation happen was actually 55 years ago in the 1970s. So to use a simple analogy on what stagflation is, imagine you are driving a car, okay, and you're trying to press the gas, you're trying to accelerate to move the car, but your parking brake is engaged, your parking brake is stuck. And no matter how much you press the gas pedal, your car will not move. So what is happening? You are actually burning through gas, you're burning through money, which is increasing in prices. But actually, your car is not moving forward, right? There is no economic growth. So this is exactly what stagflation is where there is increase in prices for consumers, but at the same time, the economy is not growing very well. It is stagnating. Now, for an economy to be in stagflation, right? The good news is it's not only related to one thing. Okay, it is related to three things. The first thing is actually your paycheck, right? Which is the cost of goods. So what happens is that your paycheck will not go as far anymore because the cost of everyday things like your groceries, like your gas, like your rent, every single thing, even your essential things that you buy on a day-to-day basis is going up. For example, like a plate of chicken rice costs you $4. But right now, if everything is getting expensive, even with your salary remaining the same, a plate of chicken rice will cost $5, $6, right? Everything is getting more expensive, but nothing is being changed about your salary. Your salary still remains the same. This is the first thing. The second thing is the economy is stuck, right? That the economy is not growing. Businesses are not making money, right? They are getting revenue, but the growth is literally close to negligible, like 0% growth. And so with no growth, with them not making a lot of money, so they basically stop expanding, right? They stop hiring people, they stop expanding, they just maintain the status quo. Okay, this is the second thing. And the third thing that must happen at the same time is unemployment, where we see jobs totally drying out. Because businesses are not growing, it means they are not hiring. Okay, and when they are not hiring, right, in many cases, right, people also lose the jobs that they already have. So the third one is when unemployment has to be high. Now, stagflation is actually a painful thing that can happen to the economy, right? Because it will actually break the rule, right? You get high prices of a booming economy, but at the same time, people are losing jobs. More people are getting unemployed. And your salary is not going up because the businesses are not generating enough revenue to increase the salary of everyone. So it is a double whammy. Guys, imagine your living expenses going up, but your salary is not increasing and more people are getting unemployed, right? You are getting claim on both sides as well. Now, looking at these three, right, as where we are right now, we also have to look at the data. Whether are we actually in stagflation now, or are we showing any signs of really moving to stagflation? Okay, so let's look at the current state of the three things. The first one is inflation, right? And inflation, as we know, what has the recent inflation been affected by is by tariffs, right? And we can see that the latest news that we have is Trump actually raising global tariffs to 15%. And tariffs are definitely putting an upward pressure on prices. Even though we've seen the recent news that the Supreme Court has ruled Trump tariffs to be to not be valid and that they have to do the refunds. But I can tell you, the refunds is going to take years and years and years. It's not something that can be done very easily because there's so many parties involved. Right, but even with this headwind, right, we've also seen that tariffs have caused this one-time increase in inflation. But we haven't seen these global tariffs, these 15% being shown in the price yet. So in my opinion, inflation right now, the latest that we saw is sitting at 2.4% in January, which is very close to the Federal Reserve rate of 2%. So it is high enough to feel, but it is not at that level where it is very, very concerning right now. So that is inflation. The second one we have is jobs, and we look at that by looking at the unemployment rate. So we can see that unemployment rate, right, is currently at 4.3%. Okay, and in fact, earlier on 2 months ago, it was at 4.5%, but 4.3% you can see is the norm, right? So this is actually quite okay, right? Even though it is higher than the Federal Reserve target, which is 4%, right? This is not as bad as when we look in history. Like back in the days, right, unemployment can go out to 8%, 10%, even higher as well. While at the same time, right, while I think that there is definitely a risk of AI displacing specific roles, we are not seeing a huge economy-wide job losses yet. And what economists are calling this, from what I read, is low hire, low fire market. Where businesses are very hesitant to add staff, to add new employees, but they are also not rushing to really fire many people at once. Now, with that being said, right, I also want to share this news with all of you. And I think some of you have seen this before. It's about this company where their shares actually surged up to close to 30%. as the CEO Jack Dorsey, which was the CEO of Twitter last time. He announced plans to fire 4,000 people. This is 40% of his workforce. Okay. And what was his reason? It is because of AI, that the company has developed tools that do not require so many people anymore from AI. So we can see that, and why the stock surge, interestingly, right? As Wall Street basically see this as the company is going to save more money, they are going to get more profits. So even though it's bad for the employees, they are getting fired, right? As an investor, it is good when a company fires people because they are cutting costs. And so what we are seeing, right, even though unemployment it is at that level, right, it is also very, very important to know that there are this kind of firing, this kind of letting go, they are taking places. Now, this news that was released actually on Friday, actually it got a lot of attention, right? And this might also signal to a lot of other companies to do the same and all. So I would say that for unemployment, we are not out of the woods yet, because even though yes, AI will displace job, we actually haven't really seen that full extent where more people are getting let go. Okay, so it's something that we have to monitor, and if over the next few months unemployment actually starts to creep up higher, that's where that risk of stagflation will become a bit more apparent. Okay, so expect even more layoffs across the tech sector as companies adopt more AI tools and they realize that they can actually replace people. Now, this is the second one. The third one is actually GDP, right? When we look at the growth, remember stagflation, right, requires the economy to stop growing. And currently, you can see that the US GDP is forecast to expand roughly about 2.5% in 2026. Okay. Now, the latest GDP that we saw, right, in Q4 2025, the latest year-on-year GDP that we saw was roughly 1.5%, which is actually lower than expected. Even though considering Q4 is what it is, the holiday season where people will probably be spending a lot more. But year on year, right, the GDP in Q4 is actually quite low at 1.5%. Okay. But right now, I would say that it is still very early to say, right, for the this year 2026, right? And while we haven't seen any data, right, what we can actually track is through the consumers' spending, right? And as we see from some of the companies that reported the earnings, is a proxy for us to evaluate. Some companies, they are noticing that consumers are trading down. That means they, like Walmart, right? Consumers are purchasing even more essentials. They are buying less of like the electronics, which are all not necessities, it's all wants, right? So we are seeing a little bit of signs of consumer trade down. But as of right now, right, as of today's context, right, the economy is not really shrinking as much, or it's not really stuck. So when we look at these three all together, right, I will say that we are definitely not at the level of stagnation yet. And hopefully we won't get there. But there are definitely some things that are showing slightly under the cracks that is happening, right? Like unemployment of Block letting people go. In fact, we are seeing more companies doing that, like this GDP that is slower than expected. All of these are not very loud alarms, but these are alarms for us to take note. So the macro picture is messy, right? You can see that there's full of friction and uncertainty, and Monday is going to be even more with the war. But when we look at individual companies, it actually tells us a different story, right? Because despite what we see right now, where what we saw for corporate companies in the AI sector is actually stronger than ever. So let's look at some of the earnings of the companies that reported on Friday. The first one is Dell Technology. I'm pretty sure that if you are in the workforce, most of your computers are Dell. If it's not Dell, it's Lenovo. But for most of the companies, they are all using Dell laptops. Okay, and they reported their earnings. The stock actually surged 22% on their strong AI server outlook and including buyback. But on top of this $10 billion buyback, right, what they actually had is a $43 billion backlog. That means $43 billion worth of orders that they will fulfill. And this was what led to the stock to jump 22%. Okay, so this actually confirms that how, in a way, companies are shifting all their budget towards AI, moving away from traditional IT and pouring it into hardware required for AI. Even for companies like Dell, which are doing this kind of legacy, they are all pouring more into AI servers. Now, the main risk is not demand, is whether Dell can actually get enough GPU to build the servers. Okay, so this is for Dell. But at the same time, right, in contrast to hardware, software, like specifically for Zscaler, is actually what we saw. They are actually facing a crisis. And for Zscaler, right, they are beating earnings and they're raising their guidance. Very solid quarter, but the stock still plunged by 15%. Why? It is because their losses are widening. So for context, Zscaler is a cybersecurity company, right? They are doing zero trust. That means more on the front end of cyber security. And of course, number one, they were affected by Claude's AI, the Claude's AI code security, the one that they launched recently that affected all cybersecurity companies. But one more important thing, apart from their solid quarter, why the market didn't like it, right? It was because of their operating losses. They were actually losing even more money than the past 3 quarters. So as you know right now, right, where are we in the market now? And we've seen this for a few of the companies that you saw that I shared in the earlier videos, is that now the market is punishing companies that are not profitable. It is very, very clear of the situation they are in right now. Right, what the markets want to see is in the near term, right? Companies are reporting more profits, right? They are reporting that they are losing lesser money or they are making more money. And if any company reports that they are losing more money, the market will just sell it down. This is the nature of the market right now. Okay, so this is something that every one of you should take note of because it will help you to know what is the reason for the sell down. Because some of you might be thinking, how come it's a great quarter but the stock still drop? And this is the entire reason. Okay, losing money. And let me share with you another example. This is not really a company that has reported their earnings, but it's another example of how when a company has more money, the market will reward it. And it is a company that every one of us know, Netflix. Okay, so the drama has really, it seems to be concluding, right? They have really dropped the Warner Bros. Bid because Paramount came in with the hostile bid and they keep increasing the price, and now Netflix has walked away. On top of that, they are going to get another over $2 billion of cash from Warner Brothers for breaking the deal, right? And you can see Netflix, after the deal has been announced, that they are not going to pursue it, right? You can see despite this was when it was announced. And over the past 5 days, they were up about 23%, right? So what do the markets love about this is because Netflix is not going to spend that money again. So again, like what I shared, the markets are rewarding companies that have a lot of money, they have a lot of cash right now. So when you invest in companies, right, you want to look into those that have very strong cash flow as well. So this also reinforces Netflix dominance in the market. Now, moving on to what is coming up this week. Now, there's a few more earnings that will be coming out for us to understand more about the economy, right? Because next week, there's not a lot of economic data coming out. We have Target and we have Costco that will tell us more about the consumer. And in terms of the AI build out, we have Broadcom. This will be one of the most important one of next week. Broadcom's earnings will be one that the whole world will be looking at. And when we look at the AI side of things, the AI cybersecurity, right, CrowdStrike will be the one that I will personally be looking at because they are one of the most well-followed cybersecurity platform. Cloudflare has really reported. So CrowdStrike will be the one that will give us some insights whether this new cloud code security will be a threat or not. So I'm pretty sure that this will be a question asked during the earnings call as well. Now, to sum up everything, right, what is my overall take of the market that we are seeing right now? So, of course, when we look at the macro side, there's a lot of uncertainty. In fact, over the past few months, right, macro has been dominating the headlines, where we saw software stocks selling down. And even though a lot of companies are reporting massively strong earnings like Nvidia, and they'll drop about 5%, 4% every day. Now, I think from when they reported the earnings, they are down close to 10% right now, despite being one of the best. So it's very clear that the market has changed, right? The market has changed totally. Where if a company is not making enough money or a company is not deemed to be have a very strong profits down the road, the market will immediately sell it down. Okay, and in addition to that, you pair it with all the uncertainty in the market right now, it is definitely looking a bit more risk-off approach. So as to my personal game plan for next week, it is pretty simple, right? I think that opportunities will always be there in the market. In fact, we have seen over the past few weeks. So I think that on Friday, we really saw some very nice opportunity. I'm pretty sure next week on Monday, there'll be a little bit more opportunities as well. But I will not be in a rush to go and load in and buy so many things as well, because it's very important to know how the situation will unfold, especially the US-Iran stuff. Even though war effects do not really affect the market in the long term, in the short term, it will affect. And what does it mean? It means that in the short term, there will be opportunities, right? So I'll be looking at that, and I'll also be monitoring the earnings of the companies, especially Broadcom, CrowdStrike, like what you saw next time, to better understand about the risk that I shared with you about stagflation as well. So that's my overall take. I think that for you as an investor, now is the time for you to be a little bit aggressive, right? A little bit aggressive, but at the same time, you don't want to show hand and deploy all your cash. I think it's always very important to keep a very strong, healthy buffer of cash, regardless of how the market is. Now, that's all that I have for you for today's video. So if you enjoy such content, be sure to hit that like and subscribe button. It would really, really help me to create more of such content for you. So thank you, and I'll see you in the next video.